Welcome back to our series on credit risk. Today, we're breaking down historical default probabilities and how rating migration matrices actually work. To start, let's look at borrowing ratings. S&P ratings range from AAA, which represents the highest quality, down to D, which indicates a payment default. We generally split these into two buckets: investment-grade bonds, which are rated AA to BBB, and non-investment grade or junk bonds, which are rated BB down to D. When we look at the data, we focus on two types of risk. First is the cumulative probability of default, which is the total chance a bond defaults by the end of a specific year. Second is the marginal probability of default, which is the chance of defaulting specifically within a single year. To calculate the marginal probability, you simply take the cumulative probability of the current year and subtract the cumulative probability of the previous year. For example, if an AA-rated bond has a cumulative default probability of 0.11% by year 3 and 0.06% by year 2, the marginal probability specifically within year 3 is 0.11% minus 0.06%, which equals 0.05%. Interestingly, the relationship between ratings and time varies. For investment-grade bonds, the marginal probability of default typically increases over time because, while they are stable at the outset, there is more room for financial deterioration over a longer horizon. However, for many non-investment grade bonds, like those rated B, the marginal probabilities may actually start to decrease after the first few years. This is because the initial years are critical for survival. If a high-risk issuer doesn't default early on, it suggests their financial state may not be as precarious as initially assessed.